As a 31-year-old guy, I want to make sure that I'm doing everything right to retire as early as possible and also not making any silly mistakes that are going to slow that process down. So in this video, I'm going to show you how to chop off years of extra time and retire from your investments way faster by avoiding dividend stocks, of all things. There are two reasons why avoiding dividend stocks will let you retire earlier that we're going to be covering in this video. The first is the tax drag effect, but this one's obvious. This line shows how a $1 investment would have grown if invested in the S&P 500 with dividends not being reinvested. This line shows how the $1 would have grown if you reinvested your dividends each time they're received. And this line shows a more realistic expectation of what your results would have been when reinvesting dividends once you factor in the tax drag. This line assumes you're paying 15% taxes on your dividend income before it can be reinvested. So 10% annual returns has been about the market average over the past few decades. So let's work with that, and we'll also continue to use a 15% tax drag for this example. All of these lines show how your invested capital would grow, growing by 10% annually, but the difference between each line is how much of that 10% is in the form of dividends. If 6% of your 10% annual returns are in the form of dividends, then after 40 years, you'll have significantly less than if none of your returns were in the form of dividends because of the tax drag. If all of your 10% returns were in the form of market value appreciation, on the other hand, your investment account would actually be about 37% higher after 40 years. Or another way to look at it is if this line here represented how much money you needed to retire, then it means the difference of about 3.4 years. But what about receiving dividend income in retirement, you might be asking? You might be saying, I don't want to have to sell any of my shares to fund my retirement. Well, good question. And this leads me to the second reason to avoid dividend stocks. And to explain it, we're going to have a look at an analogy that Warren Buffett used in his 1984 shareholder letter. But first, a quick pre-explanation is required. So dividends get paid from a company's earnings, but not all earnings are created equal. There's restricted earnings and there's unrestricted earnings. See, restricted earnings are the earnings that can't be paid out because if they were, it would lead to the business's eventual failure. And this is because some of the earnings must be reinvested back into the business just to maintain its current competitive position and maintain its current unit volume of sales. Now, unrestricted earnings, on the other hand, are the earnings that could be distributed to the shareholders or retained. And as a shareholder, you would obviously prefer if the management chooses to do with those unrestricted earnings whatever is in your best interest. Now, sometimes that can mean distributing them to you as a dividend, but often it's not. So with that said, I'm going to share this example from Warren Buffett, and then we'll tie it all together. Now, imagine you're the owner of a risk-free 10% perpetual bond. So what this means is this bond will give you 10% every year forever. But this bond has a special feature. You can either take your 10% in cash, or you can choose to reinvest your 10% into more 10% bonds with the same cash or reinvest option. Now, if in any year the risk-free bond rate is 5%, then it wouldn't make any sense to take your 10% in cash because choosing more 10% bonds just makes more sense. Because if the risk-free bond rate available is 5%, then your 10% risk-free bond will trade at a premium price. And so even if you needed cash to live off of, you'd still be better off selecting the option of receiving more 10% bonds and then immediately selling them. This would be better than taking the option of getting your 10% as cash. And if you choose the option of taking more 10% bonds and then immediately selling them, you'll be left with more cash in the end. And that's because, again, when the risk-free bond rate available is 5%, you'll be able to sell your 10% risk-free bonds for a premium price. All right, and if in other years the risk-free bond rate available is 15%, then it wouldn't make any sense to choose the option of taking more bonds. Because why would you want more 10% risk-free bonds when 15% risk-free bonds are available? So you would take the cash. And even if you had no need for cash, you'd still take the cash, because if what you wanted was more 10% risk-free bonds, then you could just take the cash and then immediately go and buy more 10% risk-free bonds, and you'd be able to buy them at a discount price due to the fact that 15% risk-free bonds are currently available. Now, if what I just said wasn't perfectly clear, you might want to listen to that section again. I know I had to sort of reread it and spend some time thinking about it when I first learned this, or go ahead and read how Warren Buffett himself put it in his 1984 shareholder letter. Nonetheless, it works the same way with stocks. Check this out. If a stock trades above its book value, which will naturally happen if a company earns a decent return on equity, then every dollar of earnings the company retains is turned into over $1 of market value. So if a company trades at 120% of book value, then every dollar retained turns into $1.20 of market value. And so what this means is that even if you need cash to live, it would actually be better for you if the company still retains the earnings, thus turning every $1 into $1.20 of market value, and then for you to go ahead and sell the appropriate number of shares as per your cash needs. And if you don't need any cash right now and your plan is just to reinvest the dividends that you receive, then it makes even more sense for the company to retain the earnings, because otherwise the company would be paying out that money to you just for you to pay taxes on it before proceeding to use what's left after the taxes have been paid to buy more shares at that 120% market value premium. Now, I know the idea of selling shares probably doesn't feel right, but it is logically what makes the most sense. Here's what Buffett says.
Every dollar that's been reinvested in Berkshire has created more than $1 of market value. So it's much more intelligent. If you control the dividend policy of Berkshire, it's much more intelligent for people to leave the dollar in, have it valued at $1.20 or $1.30 or whatever it may be valued, and then sell off a little piece if they want the income or if they want to receive some cash. And the logic of it, I think, is unquestionable.
This doesn't mean that dividends are always the worst option, by the way. If a company trades at 50% of book value because it's a business with economics that aren't that great, then every dollar retained actually becomes only 50 cents of market value. And in this scenario, you would definitely prefer if the business were to pay out all of their unrestricted earnings to you as a dividend rather than retain them. Great companies also, by definition, generate tons of excess cash above and beyond what could be reinvested back into the business in a way that would earn a return higher than what is generally available to investors. And so with this excess cash, these companies are mostly left with three options: buy up other businesses, pay it out as a dividend, or buy back stock. And the best of these three options will always depend on current conditions. None of them are the best no matter what. And the more that you understand what good capital allocation looks like, the better you'll be able to identify a company that has management that also understands this. And I think one mistake that people make is just assuming that all CEOs are created equal, but in reality, identical businesses could be run by different managers and produce very different long-term results depending on how the CEO allocates those unrestricted earnings. Now, but what if the stock market happens to be down because of a major crash or correction at the same time I'm about to retire? You might be saying, I don't want to have to sell shares during these unideal moments. And it's hard to give one answer that covers all scenarios, but here's what I'm thinking for me, and here's what I'm planning for myself. So for one thing, because I prefer owning great businesses, and great businesses tend to recover from extreme market panics faster than not so great businesses, hopefully moments that the stock market is pricing my shares below what they're worth will be short-lived. Second, even if dividends are not the most important thing to me when choosing which stocks to buy, I will most likely end up owning various dividend-paying stocks when the time comes that I'm retiring anyways. Simply because, as we said, excess capital is a natural consequence of a business being great, and so there probably will be some dividends to go around. So I'm not saying you should be avoiding dividend-paying stocks altogether. What I am saying, though, is that it is a common mistake for investors to be so completely focused on them. Third, looking back to this graph from earlier in this video, if you have more capital in retirement because your focus wasn't on dividends throughout your whole investing career, then you're just gonna have a better cushion in general to weather the storm of a market downturn. And then fourth, in retirement, I intend to have credit available to me that I could tap into and borrow from. So if I'm needing cash to live and my stocks are currently trading at a price below their value, then this will be an option for me. If you have a home, you can use your home equity line of credit, and you can also use your stocks as collateral to get a low interest line of credit. And if you're using stocks as collateral, because you'd only be borrowing 6 months to a year's worth of living expenses at a time, there would be almost zero chance of you getting a margin call since the amount you're borrowing is so small compared to the total size. And technically, throughout your entire retirement, anytime you needed income, you could make a decision at that time as to which one makes most sense at that moment. Borrowing money at low interest rates or selling some stock. Because at any given moment, one might be better than the other. And now, if you want to keep expanding your stock investing knowledge and learn the answer to how much cash it makes sense to hold in your portfolio and how holding cash can help you get richer faster, I made this other great video for you right here. So click here or tap here right now to watch that one next, because this is the video that I think you should be watching next. Also, as a quick disclaimer, I'm not your financial advisor. I'm just someone that enjoys helping you learn about stock investing. So I'll see you in the next one right here.